$8 trillion dollars. That is how much European money is sitting in U.S. treasuries, U.S. stocks, and U.S. bonds right now. $8 trillion, 24% of the entire American debt market. And Washington needs every single dollar of it to keep the lights on. Now, what if it started leaving, not crashing out overnight, not a panic, just quietly, steadily, institution by institution, pension fund by pension fund, sovereign wealth fund by sovereign wealth fund, rotating out of dollars and into something else? What would that do to America's ability to borrow? What would that do to interest rates? What would that do to every mortgage, every car loan, every government program that depends on cheap debt to survive? That process started, and yesterday the woman who runs the pipes that move the world's money confirmed it on camera. Her name is Valerie Urbain. She is the CEO of Euroclear. Euroclear is not a bank. It is not a hedge fund. It is the actual infrastructure that the global financial system runs on. When governments settle bond trades, when institutions move trillions across borders, when the world's biggest money does anything, Euroclear is in the middle of it. They are the most important financial institution most people have never heard of. Yesterday, April 14th, 2026, Valerie Urbain flew to Hong Kong, sat down with Bloomberg TV, and said this: China's push to elevate the yuan as a global reserve currency is creating a window of opportunity. And then she said, diversification is truly playing a role in capital markets. Read that again slowly. The person who runs the infrastructure of the dollar system just flew to China and told the world that the yuan is creating a window. She did not say it might. She did not say it could. She said it is. That is your signal. Because here is what is happening around that signal right now. 2 weeks ago, Canada's finance minister, the Bank of Canada governor, and every major Canadian bank CEO landed in Beijing and signed a deal to wire Canada's financial system directly into China's. Canadian oil exports to China have nearly tripled in 1 year and now exceed what Canada sells to the United States. Deutsche Bank went to China's bond market last month and got 60% more orders than bonds it had to sell. The yuan has gained 3.7% against the euro, while the dollar has lost nearly 4%. France pulled 130 tons of gold out of the New York Fed and shipped it home to Paris. Every one of these things happened recently, and they are all pointing in the same direction. By the end of this video, you are going to understand exactly why the $8 trillion is starting to move, where it is going, and why the Trump administration's own behavior is the single biggest accelerant in this entire story. Stay with me, because this one actually matters. Let us go back to what Euroclear CEO Valerie Urbain actually said, and why it matters so much. She was speaking at HSBC's Global Investment Summit in Hong Kong on April 14th. She told Bloomberg TV directly that the People's Bank of China's effort to position the yuan as an alternative reserve currency is opening new avenues for international financial cooperation. She described it as a window of opportunity, but emphasized that the next step requires China to align its regulatory framework with internationally accepted standards. That last part is important. Euroclear is not in the business of cheerleading. They are in the business of connecting buyers and sellers, taking their cut, and managing risk. When the CEO says there is a window of opportunity, what she is really saying is, there is money to be made here. There is demand we cannot ignore, and we want to be the bridge. What Euroclear wants to build is a link between European institutional investors and Chinese assets, specifically through Hong Kong, which is functioning as the testing ground for yuan-denominated instruments. The idea is to package RMB bonds and Chinese securities in a format that Western pension funds, hedge funds, and sovereign wealth funds can actually use. Handle the regulatory translation, handle the settlement, make it easy. For China, this is the internationalization play they have been working toward for years. Get your currency into Western portfolios. Build demand. Build pricing power. The more countries hold yuan assets, the more countries conduct trade in yuan. It compounds. For Euroclear, they become the central node of a new financial axis, the same role they play in the dollar system, now replicated for the yuan system. That is an enormous business opportunity, and they know it. Now, here is what is driving the urgency right now. It is not just a slow strategic shift. The Iran war cracked things open, and the data is very clear on exactly how badly. Oil was sitting at $60 per barrel before the Iran war started. Trump drove it to nearly 120. That single move hit Europe like a freight train. Europe was already dealing with an energy shortage. The continent was already running on thin margins when it came to energy security. Then oil doubled and Europe felt every cent of it. In just 1 month, Eurozone inflation jumped by 60 basis points. That is a massive single-month move for a bloc that had actually brought inflation under control. Spain saw a 0.8% increase in a single month. Germany and France followed similar trajectories. Most major European economies took a direct hit. This was not a global trend. This was a direct consequence of the Iran war and the oil shock that came with it. Now layer on top of that what Washington was doing at the same time. Scott Bessent was mocking Denmark at Davos. Trump was on camera threatening to cut off all trade with Spain after Spain refused to hand over military bases. Here is what Trump actually said. Spain has absolutely nothing that we need other than great people. So we are going to cut off all trade with Spain. We do not want anything to do with Spain. That is the President of the United States threatening a NATO ally on camera. If you are sitting in Madrid or Berlin or Paris, managing a sovereign wealth fund or a pension portfolio, you are watching this and running the math. You may not be able to escape the U.S. consumer market. Your exporters need that access. But your reserves, your long-term asset holdings, those are a choice. And suddenly that choice looks very different. Here is the core problem. Dollar debasement is not a future risk. It is a present one. Washington's fiscal trajectory is what it is. The deficits are structural. The debt is real. Every dollar you hold today may buy you less energy, less food, less of anything next year. The yield you collect on treasuries may look attractive on paper, but if the currency falls underneath you, that yield disappears. It can go negative in real terms. Here is where theory becomes math, and money moves on math. Just over a month ago, Deutsche Bank issued panda bonds. These are Yuan-denominated bonds issued by a foreign entity inside China's domestic market. Deutsche Bank sold 5.5 billion RMB worth. And here is what happened. Total orders came in at 8.7 billion RMB. That is 60% more demand than what was available. The offering was massively oversubscribed. An EU bank went to the Chinese bond market and the world lined up to buy. That is the demand signal, and it came in at a yield of under 2%, less than 2%. That is not a yield you accept unless you understand what the underlying currency is doing. So, let us run the actual numbers. Over the last 12 months, the Chinese yuan has appreciated 3.7% against the euro. In that same period, the dollar has fallen almost 4% against the euro. Now, say you are a European investor choosing between U.S. treasuries and Chinese bonds. The treasury gives you 3 to 4% per year in yield. Sounds reasonable. But if the dollar falls 4% against your home currency, your real return is somewhere between 0 and negative. You collected your coupon and lost it all on currency movement. Now take the Chinese bond. The yield is under 2%, on paper, weaker. But if the yuan appreciates 3.7% against the euro, your total real return is roughly 5.7%. You made more on the currency move than you ever would have collected in yield. A 2% yield bond with a strong currency beats a 4% yield bond with a weakening currency every single time. Euroclear sees this math. European asset managers see this math. Belgian wealth managers are already pulling back from treasuries because of exactly this valuation risk. They are not doing it because they dislike America. They are doing it because they want to protect the value of what they are holding, and this goes beyond private investors. France has been pulling gold out of the Federal Reserve in New York. Roughly 130 tons were moved back to Paris and are now sitting in French vaults. China has been watching that closely. Chinese media has been running with the story. The question being asked openly in Beijing is, what if countries like France eventually store their gold there instead? That question was once hypothetical. It is getting less hypothetical by the week. Let us talk about the number that should be keeping Bessent and the Treasury Department awake at night. Europe holds at minimum $8 trillion in U.S. assets. Treasuries, equities, corporate bonds, not just governments. Private funds, banks, pension systems, insurance companies, all in there. That $8 trillion represents 24% of the entire $34 trillion U.S. Treasury market, more than Asia and the Middle East combined. Here is why that matters. The US government is not running a surplus. It is running massive deficits, and it needs buyers for that debt constantly. Europe is not just a holder of existing debt. European institutions are active buyers of new issuance. They show up at auctions. They roll over their positions. They are the engine that keeps US deficit financing working. If China redirects even a fraction of that 8 trillion toward RMB assets, the consequences are severe. The treasury market faces real pressure. Yields need to rise to attract buyers. And higher yields mean higher borrowing costs for everything in America. Mortgages, car loans, corporate debt, government spending. The feedback loop is brutal. And this is not speculation about a scenario that might happen. Asset managers across the EU are already in motion. The flows have started, the reallocation is underway. It is gradual because institutions of this size move gradually. But the direction is clear, and it is accelerating. The Iran war, Trump's trade threats, the frozen Russian reserves, the dollar debasement trajectory. Every one of these is adding pressure to the same valve. And the valve is slowly opening. Now let us talk about Canada, because what happened 2 weeks ago is one of the most significant moves in this story, and it got almost no coverage in the United States. On April 3rd, 2026, Canadian Finance Minister François-Philippe Champagne landed in Beijing. He did not go alone. Bank of Canada. Governor Tiff Macklem was on the plane. So were the CEOs of Canada's major banks, insurance companies, and institutional investors, including Brookfield Asset Management and the Canada Pension Plan Investment Board. It was a full financial delegation. Bay Street went to Beijing. They did not leave empty-handed. Canada and China signed a joint statement to deepen financial sector ties. The two sides agreed to expand Canadian bank licensing in China, more services, more access to Chinese bond markets. Champagne met directly with China's Vice Premier He Lifeng and China's Finance Minister Lan Foan. These were not courtesy meetings. These were working sessions. Champagne was direct about why. He said, "If you want to expand your trade, you need financial services. Canada's goal is to increase exports to China by 50% by 2030. The current trading relationship sits at $120 billion. Champagne acknowledged that given the size of both economies, that number should be much higher. This trip followed Prime Minister Mark Carney's January visit to Beijing, where he met President Xi Jinping directly. That meeting produced real results. Canada brought its EV tariff down from 100% to 6.1%, and China removed tariffs on Canadian canola and seafood. The relationship is being rebuilt from the ground up. What does this mean in financial terms? Canadian banks operating in China can settle trade payments locally. Canadian dollar to RMB conversions happen faster, cheaper, without a U.S. bank in the middle. Bilateral trade between China and Canada becomes increasingly invisible to Washington, more of a black box, harder to monitor, harder to sanction. Even if Canada or China were ever cut off from SWIFT, trade could continue through this bilateral banking channel without disruption. That is the whole point. The oil numbers make Canada's move even clearer. In 2024, Canada exported 5.7 million tons of oil to China through its West Coast pipeline. Last year, that number nearly tripled to 15.5 million tons. That is now double what Canada sells to the United States. Double. And as more Canadian banks establish operations in China to facilitate bilateral payments, that volume will keep growing. Canada is not abandoning its relationship with the U.S., but it is building a parallel financial architecture that does not depend on it. That is the Carney strategy in practice. As he said in Davos, hope is not a plan, and nostalgia is not a strategy. Now here is the thing that makes all of this so important. Trump understands at some level what is actually at stake. The petrodollar system is cracking. Iran selling oil in Yuan, the $2 million pipeline toll settlements happening in Yuan, Canada's West Coast oil flowing into China and being paid for in bilateral currencies that bypass the dollar entirely. Every one of those transactions is a transaction the US dollar does not touch, and the numbers compound. Every country that stores Yuan assets has an incentive to conduct more trade in Yuan because they need to earn Yuan to cover those positions. It is a flywheel. Once it starts spinning, it is very hard to slow down. The Iran war, intended or not, has become an accelerant. China needs to find oil suppliers who are not located in the Middle East. The U.S. blockade of Hormuz is a direct threat to China's energy security. Canada's West Coast pipeline is the answer to that problem. The war created the demand. Canada is meeting it. And as that trade grows, so does the Yuan settlement that comes with it. Meanwhile, Washington is burning its relationships with every ally it might need to slow this process. Spain threatened. Denmark mocked. France's gold pulled out of New York. Belgium moving away from treasuries. Every act of aggression from the Trump administration pushes another piece of Europe's $8 trillion a little closer to the exit. So, where does this go? Let us map it out. Euroclear moves next. The infrastructure is coming. The Hong Kong testing ground for Yuan-denominated instruments is being built right now. When Euroclear completes the link between EU investors and Chinese assets, the custody function, the settlement function, the standardized access, it will be plug and play for every pension fund and sovereign wealth fund in Europe. The friction will be gone. And when friction is gone, capital moves faster. There is a lot of capital pointed in this direction. Deutsche Bank's Panda bond result told the market what it needed to know. The demand is real. It is institutional. It is not speculative. European banks and asset managers are not buying Chinese bonds because they love Beijing. They are buying them because the math says Chinese bonds in a rising yuan beat U.S. treasuries in a falling dollar. Canada has just signed the framework to make its financial system a conduit for yuan flows. Champagne's delegation included the Canada Pension Plan Investment Board. When a pension fund of that size starts routing through Chinese channels, the volumes involved are significant, and France's gold repatriation is its own signal. If even one EU central bank decides to store a portion of its gold in Beijing instead of New York, a scenario now being openly discussed in Chinese media, that is a psychological and structural shift that goes far beyond the tonnage involved. The critical variable is China's regulatory alignment. Euroclear's CEO was specific about this. The next step is China meeting international standards for transparency, custody, and market access. Beijing knows this. The Panda bond program, the Hong Kong testing ground, the CIPS payment system processing 9.6 trillion yuan daily. These are all moves toward that standard. China is not trying to blow up the dollar system overnight. That would hurt China too. What they are doing is building a parallel system piece by piece until one day the parallel system is large enough to stand on its own, and Washington's behavior is doing China's work for it. Here is the bottom line. The de-dollarization trend is not going to reverse. The conditions driving it are not going away. U.S. fiscal recklessness, Trump's use of trade as a weapon, the weaponization of dollar reserves against Russia, the Iran war oil shock. None of those conditions are disappearing. Yesterday, the CEO of the largest settlement system on Earth stood in Hong Kong and confirmed that the yuan is creating a window of opportunity. 2 weeks ago, Canada signed a financial pact with Beijing, while the Bank of Canada governor and every major Canadian bank CEO was in the room. The $8 trillion is going to start moving, not all at once, but it is going to move. What happens when it does is something Washington has been avoiding thinking about for years. Now, they may not have a choice. Let us know in the comments, do you think Euroclear will become the bridge for yuan assets into Europe? And is Canada making the right bet by going all in on China? Drop your take below. Hit the like button and subscribe. We cover the stories that matter every single day.